Hi everyone, welcome to chapter 6, which is the application of linear equations. So in this chapter, we're going to be talking about revenue that an organization takes in and how the sales price for one product, multiply it by the number of those products that you sell, gives you your total revenue. We're also going to be looking at total costs that are incurred every time you sell a product. And those costs are broken into two different types, which is a variable cost, which is the cost you incur every time you sell a product, such as every time I sell a highlighter, it costs me 50 cents to buy that highlighter. So that's an associated cost. But say, for example, the VP of sales was on a salary of 50,000 a year. Even if we didn't sell any highlighters, we'd still have to pay that $50,000 salary. So that would be considered a fixed cost, whereas the other cost is associated every time you sell a highlighter, that 50 cents, that's called a variable cost. Okay, so let's dive in. So everybody probably sort of remembers this equation from a linear equation, y equals mx plus b. And we're going to be looking at how this equation actually relates to the costs associated with our sales. B would be the fixed cost. The M is the variable cost, such as that 50 cents that's associated with every time I sell a highlighter. And the X actually relates to how many highlighters I sell. Okay, so jumping in. Fixed costs do not change with the sales volume. So again, every time I sell a highlighter or a cup of coffee or a stapler, fixed costs don't change whether I sell one of them or whether I sell 750,000 of them. Okay, so fixed costs would be things like salaries that you promise to pay for the full year, your rent expense, or if you own the building, the associated property taxes. Whereas variable costs change in proportion to sales volume. So production costs, material costs, again, if I either make or buy the highlighters that we're selling, every time I sell a highlighter, then however much it cost us to buy that highlighter would be the variable cost that gets posted. And again, anytime you have costs or expenses, they get posted to your income statement, just like every time we have a sale, it gets posted to our income statement. And as if you remember, sales minus expenses gives us our net income. Sounds a lot like accounting class, doesn't it? Okay. So to come up with our unit variable costs, which we may know, we may not know as an organization, or we may want to just confirm. So the way we'd come up with our unit variable costs or our variable costs associated with each highlighter, we'd take, say, if we were looking at for a month, whether we were looking at for the year, we'd look at our financial statements and take our total variable costs for that period in time, divided by the number of units that we sold, and then that's how we'd come up with our unit variable costs. In the reverse, if we know what our unit variable cost is, so say 50 cents per highlighter, we know we sold 2,000 highlighters, then we'd know our total variable cost would be 1,000. 2,000 units multiplied by 0.5 for our 50 cents per unit. Okay. Sometimes there's actually mixed costs. Maybe it's a base salary plus commission for our sales force. That mixed cost would be pretty easy to break up. Like we could separate the variable costs and the fixed costs and make it so that we can see how much commission each of the salespeople make, but that we'd still have to pay their base salary as a fixed cost, whether they earned any commission on sales or not. Another mixed cost, if some of you are familiar with paying power bills for Nova Scotia Power, there's actually, if you look on your bill, there's a set amount or a base amount that everybody has to pay. And then depending on how much power you used throughout the month or the 2 months, that's an added portion to your bill. So that would be a mixed cost. Okay. So here's an example of fixed and variable costs. So Chuck is considering starting a delivery service. He can buy a used 15-foot cube truck for $32,000. Okay. He will need to hire a helper to assist with loading and unloading. Chuck feels he can charge $60 per delivery, so that would be his revenue for each delivery made, and that each delivery will require an average round-trip driving distance of 25 kilometers. He has estimated the following expenses. So now we can look at each of these expenses and figure out whether it's a fixed cost or whether it's a variable cost. So if it's a fixed cost, that's the amount you have to pay no matter what. And you can look at it on a yearly basis or you can look at it on a monthly basis. And then if it's a variable cost, then that expense doesn't happen unless there's a delivery made. Okay? So what I'd like you to do is pause this video for a couple of minutes, have a look through and see if you can figure out whether it's a variable cost or a fixed cost. Okay, so let's go through it together. So we have some fixed costs. So the truck insurance and license is $3,000 per year. Okay, so whether we make any deliveries or not, if we're going to license our truck and insure our truck, just in case we have deliveries, then we have to pay it. Okay, so that would be a fixed cost. And the way you'd be able to come up with the fixed amount per month is by dividing the per year amount by 12. Then we're going to look at our wages. And if it's $6,000 per month, wages / salaries. A lot of times wages are a per hour basis, whereas salaries is a per month or a per year. But in this case, they're talking about on a per month basis, we are committed to pay $6,000. So we want those individuals on the job, whether there's a delivery or not. So that would be considered a fixed cost. And EI and CPP premiums are something that the company has to pay for all of their employees. They have to submit it to the government. So that's also going to be a fixed cost that's related to wages and benefits, so to speak. Cell phone, we have to pay our cell phone no matter what. Business license, same thing. It's going to be $180 per year. So we're going to divide that by 12 to come up with $15 per month. Okay, so now let's look at the rest. So we have fuel. So $100 for 400 kilometers. Okay, so we would take the 100 divided by 400. to come up with the per kilometer, and then multiply it by the 25 because that's the average distance per delivery. So the variable cost per delivery for fuel is $6.25. Oil changes, same thing. We aren't going to have to change any oil if we didn't make any deliveries. So it'd be the same thing, $70 divided by 5,000 to come up with a per kilometer basis. Multiply that by 25 to come up with the variable cost per delivery of 35 cents. Tires, again, the same thing. We're not going to wear out the tires unless we're driving the trucks. And the only time we're driving the trucks is if we have a delivery. So same thing, we've got $900 per 75,000 on average. That'll give us a per kilometer basis multiplied by 25 kilometers per delivery, gives us 30 cents. Truck repairs and maintenance, again, the same thing on a per kilometer basis by taking 1,000 divided by 10,000, multiply that by 25 kilometers per delivery to give $2.50. And finally, truck depreciation. If you remember that the value of a vehicle depreciates over time. So we have to take it out of the asset and put it as an expense called depreciation expense on our income statement. And if we do the 180 divided by 1,000 kilometers, it gives us the per kilometer amount multiplied by 25 to give us $4.50 per delivery. Okay, so cost volume profit analysis. Okay, so looking at the cost related to the volume of products that we're selling and compare that to the actual profit that the company is making. It allows us to estimate a firm's operating profit. Okay, so that would be your net income at any sales volume given the firm's fixed and variable costs. So we want to figure out based on certain sales volumes. So if we sell 50 markers, how much are we actually going to profit? So we've got our operating profit equals total revenue minus our operating expenses. Okay. At this point, I'm going to stop the video and I will start another one. We're at the 13-minute mark. Thanks, everyone.